Hello. In July of 2014, I spoke at the Inside Bitcoin conference in Hong Kong. Unfortunately, they were not set up to record my talk, and many people have inquired about the content since then. So I'm making this video to share the content and slides with those who are unable to attend. My name is Noah Silverman. I have a doctorate in statistics from UCLA. I work with statistics, machine learning, digital ad optimization, and Bitcoin. And I was assisted by Lin Gabay, who has a doctorate in computer science from MIT. He's an ex-high-frequency trading guy from Wall Street. In this talk, we're going to cover a few things. A short tutorial on order books, for those of you who are not familiar. We're then going to describe in detail some of the Bitcoin order book behavior. We're then going to look at waiting time for price move in the Bitcoin markets, and we're going to look at upward move probabilities. Brief side note, as a statistician, I work and live in the world of probability. That means there's no guarantee that these events will happen, just probabilities. Expected values and event probabilities are only realized when you have a large number of repeated events. But the best we can do is work with expected values and probabilities given a noisy system. The inspiration for this work comes from two papers based on the traditional equity side of high-frequency trading. The names are listed here, and they have the proofs and a lot of the nasty calculus for those of you who want to dig deeper. I'm just going to show the final formulas in this talk and discuss how I applied the methods. As I mentioned before, our goal is to drill down to the smallest level of detail in the market microstructure. Individual offers for bidding and asking for small fractions of a Bitcoin happening very quickly in real time on an exchange. In order to do that, we need to understand what an order book is. So this is an example of an order book. It's sometimes referred to as a double auction, and it takes what's called price time priority, which means the best price comes first, and for orders at the same price, they're in order of time, so the earliest one comes first. In the world of other assets like stocks and currency and precious metals, this order book is very, very fast. Being updated thousands, if not tens of thousands of times per second, so it's very complicated to track. Bitcoin is new enough and slow enough that we can actually pull all of this detailed data and do a thorough analysis. Now, in this example order book, the red cells on the top represent people asking for a deal. In a sense, they're selling Bitcoin, and that's the price they're asking. And the green represent people buying or bidding to buy a Bitcoin. And you'll see the best bid price is $99, and the best ask price is $100. Not uncommon. You'll see a bid-ask spread, because if they were the same price, the deal would be done and it would be taken out of the book. So how does an order book work? Here's an example. I want to sell one Bitcoin at $100. Well, there are already two other people in line ahead of me. There's somebody selling 2 Bitcoins at 100 and somebody else selling 10 Bitcoins at 100. So I go to the back of the line. There's no deal to be made. There's nothing I can do. My order sits and waits until those other people's orders are taken or they cancel them. Anybody can cancel an order in the order book at any time as long as it hasn't been matched. Once it's matched, the deal is made and that's a contract. Now, if I'm really eager to sell, maybe I say, you know what, I'll sell that at 99 because there's someone on the bid side offering to pay 99. And immediately my order will match, their bid will come off the book, and a deal is done. Now, if I wanted to sell 5 Bitcoins at $99, that would be impossible. As you can see in the order book here, there's somebody selling 1 Bitcoin for 99 and somebody else selling 2 Bitcoins at 99. So I could match those 3. I'd be left with 2 unmatched, or I'd have to sell those 2 at 98 and take the orders further down the book. So this is an example of when you purchase Bitcoins, you very, very rarely are going to get the price if you're quoted a single price, because the reality is your order may be filled by taking up several different orders in the order book, all at different prices, and you'll sort of have an average price that you get things for. So what do we do with all this? We wrote some software to query the API, that's the programmatic interface of 2 of the biggest exchanges, Bitstamp and BTC China, And unfortunately, unlike Wall Street, they don't push information to you. You have to ask for it or pull it. So we pulled it every 5 seconds and saved this to our computer for 2 weeks. And that turned into 241,920 files that we've pulled with all the data in there. Here's an example of what a file looks like. It's in something called the JSON format, JavaScript object notation, and it's a snapshot of the order book. So every 5 seconds, we're getting a snapshot of what that book looks like. Now, a quick caveat, something could have changed. Maybe an order went in and came back out in between us doing these 5-second pulls and we wouldn't see it. But for this study, a 5-second snapshot was the best we have. And you'll see there's a nice, in this example, there's a timestamp, which is done in something called Unix time, and it's seconds since January 1st, 1970, Greenwich Mean Time. And there's a list of bids and a list of asks sorted by price, and the next to that is the quantity. Here you'll see there's a $2.40 spread between the lowest ask price and the highest bid price, and that gives us a mid price of $588.15. Now, let's look at what a spread means. And this is a made-up fictitious pricing just for this discussion. It's a stylized order book. In this case, there are offers totaling 17 Bitcoins to be sold under the QA, the quantity ask column, and there's 20 Bitcoins that people want to buy under the QB column. So the spread between 99 and 100, if you just go down the middle, is $99.50. There's mid price. There's a $1 spread and a $99.50 mid price. Now you'll notice each queue is composed of multiple orders belonging to different people. We refer to the ask queue and the bid queue as a BBO, and that's an acronym for best bid and offer, just convenient notation. Now, what happens if somebody buys some Bitcoins? Well, in this case, I bought 10 Bitcoins, so the ask queue dropped, we'll go back, from the 17 that were available. There's now 7 left at that price. Interestingly, the mid price has not changed and the spread has not changed. There was, in a sense, no impact on the market from my order. It hasn't changed the price anybody else sees or quotes, even though I just bought a bunch. Now, if somebody came along and bought the other 7 Bitcoins, that queue would be depleted and you'd see this. Now, the best asking price is $101 because we bought up all the Bitcoins that were offered at $100. So now we have a $2 spread and the mid price is $100. So what you're seeing here is what we call market microstructure. The price doesn't magically move. It makes measured jumps up and down depending on when queues fill up with new orders or the queues get depleted and get empty and things shift. People always buy and sell at the best price they can, and so the queues are constantly growing and shrinking. Now, this was a stylized order book. Often, what you'll see in the Bitcoin world looks more like this. You'll notice there's a lot of large queues on the ask side in this example, and some very tiny queues on the bid side. The problem with looking at mid price is you don't know if there's 1 million Bitcoins on one side or if there's one Satoshi, a millionth of a Bitcoin on one side. So with this example on the screen, it would there'd be a $1 spread and a reported mid price of 97.5, which sounds reasonable. But if you actually step back and look at the book, the queues at both 97 and 96 are minuscule. There's nothing in there. So really, the weight of the bids is at 96.5, and there's a $3 spread. But that's not something that's ever reported anywhere, and you would only know this by looking at the order book yourself, which I encourage you to do. Just briefly for the formality, the mid price is the asking price and the bid price divided by 2. It's just the average. Now, this is an old problem. It's been around the world of finance for a long time. So there's a solution to this. It's called the volume weighted average price, or what we call the VWAP. And what you do is you take the price times the volume of the ask and the price times the volume of the bid, and then you divide by the volume. In a sense, it's volume weighted, and that will account for uneven queue sizes. Now, the next evolution of that, and that's the second formula under the blue line on this slide, is you can go deeper and say, well, instead of just the best bid and ask queue, what if I walk 4 or 5 price points up into the ask queue and 4 or 5 price points down into the bid queue to really get a better weighted feel and average for what's there. And that works fairly well. Lynn and I have worked on the next evolution of this, and it's actually an algorithm that we have patent pending right now. It's what we call the global average symmetric price. So we're taking, and I'm not going to get into the math here, but we're taking pieces of the queue that are balanced off of each side. So in this case, we would take a tenth of a Bitcoin from the 97 queue because that's all there is, and then we take a tenth of a Bitcoin from the 98 ask queue. And then we take the 2/10 of a Bitcoin from the 96 on the bid side and 2 more tenths off the 98 side, and so on. And what we find is when there's an unbalanced book, it tends to work better. And here's an example. If you have a balanced book, you'll see the mid price, the VWAP, and the GASP are all very close. Not much difference. But when you get to some of these weird books where things are unbalanced, the mid price and VWAP are fairly close. The GASP really represents the state of the market and the true price of the asset better. Now, that said, we're going to twist a little bit how we look at an order book. If you think about it as a two-dimensional graph with the quantity at the best bid and the best ask, you can get a different representation. And in this case, in the upper right-hand corner, I don't have a pointer here, so you'll have to just look where the arrow starts. There are 4 Bitcoins in the ask queue and 3 Bitcoins in the bid queue. And if the axes represent the quantity of Bitcoin, a queue is depleted when you touch an axis. When this little arrow walking around gets to the side, the queue's been depleted and the price is going to move. As long as the arrow moves around within this space without touching the side, the price will never move. In formal terms, we would call this a 2D random walk. And in this example, you'll notice there's 4 in the ask queue and 3 in the bid, and then an order gets added to the bid queue. So now there's 4 in both queues, and an order gets taken off the ask queue, and now there's 4 in the bid and 3 in the ask, and so on. And if you look, it eventually walks until it hits the bid queue, which means the bid queue's been depleted. So the best bid price would be 1 step lower, and the mid price would actually jump down. Now, this leads to an interesting observation. At this level, we're more interested in the rates of things arriving and the rates of things leaving than the actual price. It has nothing to do with moving averages. It has nothing to do with technical indicators. It's simply rates of things arriving in the bid and ask queues. So we want to represent this mathematically, and we use a few Greek letters. Lambda represents the rates of new orders, and it's just the count of new orders over time. Canceled we represent with theta, and it's the count of canceled orders over time, because remember, anybody can pull an order off the book as long as it's not matched. And then filled orders we represent by the Greek symbol mu, and that's just the count of filled orders over time, or the count of, or again, all this could be the count of coins. And we're interested in knowing this because if we can learn this and track it, we can estimate when things move. So 2 things to simplify this. We're going to treat canceled orders and filled orders as the same. And the reason is simple. Both of those take the order off of the queue, off of that bar graph we saw. And for our purposes, we don't care why the order was removed. Whether somebody bought it or the seller took it off the table is irrelevant. It just means the queue was smaller. So we can treat those the same. So again, we represent, mathematically here you'll see lambda sub A for the ask lambda, and we're just adding the fill and cancel together, and the same thing for the bid. Now, if the ask queue and the bid queue, if the fill and the cancel rates are added together, and then we have the new order rate, if those are exactly equal, the book would never move. The book only moves when you have some imbalance in the order and some change in price. To start, we're going to look at the probability of the price moving, if everything balanced, and this is for 1 unit, whether it's a Bitcoin, a Satoshi, whatever you want your unit to be. And here you'll see the price, the top represents the price that it's, the probability that it's going to go up. The probability that the size of the queue is going to grow. is the rate of the ask queue over the rate of the ask plus the fill of the ask plus the cancellation of the ask. And the probability of the rate of the ask queue is going to go down is the fill and cancel over those three added together. And just to keep reiterating, the price only moves if the queue drops to zero. And again, for these rates, you have to pick your units, and you have to pick your time window and all of that. But it's a useful starting point. Now, another thing we're interested in to take this concept further is we don't just want to know the rates of the fills, cancels, and new orders at the best ask price and bid price. We want to know them $1 from the mid price, $1 from the best, $2 from the best, $3 from the best, etc. Now, since the mid price is a moving target, the easiest way to look at that is $1 from the opposite side. So the bid price that's $1 below the best ask or selling price, the bid price that's $2 below the best ask or selling price. So in this case, the step is defined as $1 or $2 or $3 below the best. And these are not even numbers. So if the best asking price was $598.27, then the bid we're looking at is $597.27. So it's $1 difference. So what does this look like? In this big graph, we have the bid queue and the ask queue. The bid is red and the green is ask in this case. And we're looking at the count of new orders that arrived over 14 days and how far away from the other side that we just described. And we did it in pennies, so it's from 0 to $20 in this case. You'll see that there's peak bid interest about $5 or $6 below the best ask, and there's peak ask interest about $3 above the best bid. Another thing to note is you'll see little spikes where those dashed lines are. The dashed lines represent even dollars, and we're going to come to that in a minute, but it's a very interesting observation. We did the same thing for BTC China, and the peak bid and ask interest is in lockstep. It's almost the exact same amount of new orders arriving on both sides, almost identical. And you'll see a bid and ask around 3 to 5 yuan from the opposite side. Now, it also has those same little spikes. Interesting. What does that mean? Well, we found a bot. And a bot is slang for automated trading software. And you can see again on the little spikes on the dashed lines. Now, we don't know who's doing this. It could be the exchange themselves. It could be an outside trader. Maybe it's just a market maker, somebody just trying to offer liquidity into the book. Not sure, but be curious to find out. If anybody wants to raise their hand and volunteer and tell us they're doing this, we'd love to hear from you. The other thing that is very indicative that this is a bot and not coincidence is the timing. For the Bitstamp orders, even dollars from the opposite side, you'll see on this graph, this is the number of seconds between those even amount orders, and they tend to come in every 64 seconds. Now, the 4 seconds is probably due to some network lag or the fact that we're only pulling the book in 5-second increments. So basically, once a minute, orders come in exactly $1 below the other side, $2, $3, etc., like clockwork for 2 weeks, and that's probably not a person. Now, for BTC China, the same behavior, but the increment tends to be 7 or 8 seconds. It's much, much faster, but same behavior. Also for the bot, we looked at where those automated orders are arriving, and you'll see both for Bitstamp and BTC China, they tend to be 1 to 5 units. Dollars for Bitstamp and yuan from BTC China sort of represent the bulk of that. Okay, to quickly review, we've talked about GASP. We've talked about arrival rates of fills and cancels and new orders, and we've talked about measuring counts of things as a distance from the opposite side, and of course we've had a general view of order book behavior. Well, so what? Why this is interesting, but why does anybody care, and why is it important to you? Well, once we have all this information and we build these rates and we're tracking them and the data, we can start to model probability distributions of outcomes. And if you're trading Bitcoin or any other asset, probabilities of outcomes is how you make your living. So the first thing we're going to look at, and again, I'm glossing over the calculus here. You can find the details in those 2 papers cited earlier. We want to look at the waiting time. What's the probability I have to wait 1 second for the price to move? What's the probability I have to wait 10 seconds for the price to move? How long do I have to sit here and wait? So what we do is you run this formula for 1 second up to maybe 100 seconds, taking the result of each one, and you can graph it. And this is a real graph that we took from the data, and you'll see there's a 36% chance you're going to wait more than 10 seconds, a 20% chance you're going to wait more than 20 seconds, and a 13% chance more than 30 seconds. Well, that's neat, but how do I interpret this? Well, it turns out if you take the derivative of those values and calculate the expected value, and again, I'm skipping the math here, you can get your expected waiting time, which is sort of your average or your best estimate if you had to take a single number that'll get you close. And in this case, it's 22.14 seconds. That's not a guarantee, but as you go through trading, if you continuously count on your expected value, it's the closest you're going to get. Now, the other thing we're doing is we're using fixed estimates of the new orders, fills, and cancel rates taken over 14 days. In reality, you probably want to do some sliding window or some weighted average or something to adjust those rates dynamically, or account for time of the day and things like that. Now, the next question we want to ask, we know how long we're going to have to wait, or we have an estimate of how long we have to wait for the price to move. The next question is, well, which way is the price going to move? Is it going up or going down? And it turns out that you can do this based on that bivariate random walk we talked about earlier. For this case, we found that the arrival rates for the bid and ask queues were almost the same, and the combined cancel fill rates for the bid ask queues were almost the same. So we're just going to assume that they're equal, and that makes the math tremendously easier, because then all we really care about is the size of the queue. If the arrival rates are consistent, then how big those queues are at any moment in time tells us the probability of the order changing. So nice 2D plot where you have the ask queue on the right side and the bid queue on the left side and the probability. And if you look at it, you'll see it sort of intuitively makes sense that the bigger the queues, the longer the wait time for the price to change. But again, we do this mathematically, and it's much more interesting. Now, during the talk, we have some Python software we wrote that will fetch data in real time and actually calculate and plot these, and it works rather well. I don't have it set up to show you that in this talk, but if there's any interest, I can probably do a video on that next time. The other issue I want to cover briefly is that Bitcoin exchanges need to evolve. In order to sort of mirror the traditional world of trading assets, whether it's corn futures or Apple stock, and to really help Bitcoin get adopted to be a little more mainstream, they need to behave a little bit more like traditional exchanges. I would like to see either a flat per trade commission or a flat per Bitcoin commission. Right now, most exchanges charge you a percentage of the dollar value of the trade, which can get very expensive relative to the change in the price and will often eat up any returns or profits you can have. You also can't calculate it ahead of time because the price is always jumping around. The other thing would be nice is what's called maker-taker fees, where it's to encourage liquidity. If you're putting an offer onto that order book and willing to sit and wait for someone to take your offer, you pay less than half the commission. And if somebody's walking in and just taking an order off the book, in a sense shrinking the size of the availability, they pay more than half the commission. So it's still the total commission for the exchange, they just shift the balance to encourage more people to put orders on the book. Another thing we'd like to see is a streaming order book, so we don't have to do these 5-second snapshots, but can actually get real-time information as bids and asks come on and off the book. And the last thing I'd like to see are proper options. Old school, traditional, vanilla calls and puts on a Bitcoin would help tremendously with price discovery and would help tremendously with hedging other investment strategies portfolios. So I'm really hoping someone will develop this. No time for questions here, obviously. My contact information, again, noah@smartmediacorp.com, or my website where I consult is www.smartmediacorp.com. Thank you, and I look forward to your comments.